Welcome to the deep dive. Today, we are taking a really exhaustive look at a company that many of you have probably written off.
Mhm.
And frankly, much of the market sees it as, painfully boring, slow, and hypercyclical. We're
Mhm.
talking about PPG Industries.
PPG.
Yeah.
Yeah, as soon as people hear paint company, their eyes glaze over. They immediately apply what they call the conglomerate discount.
Right. They see this heavy industrial materials producer, and they think it's just tied to every messy up and down of GDP.
Yeah.
Slow grower.
Exactly.
And that perception is really the hook for this entire deep dive, because when you actually look past that simplistic label of paint and you apply a deeper framework, you start to see it.
You do. When you look at the chemistry, the regulatory structure, the deliberate actions they've taken,
You uncover a business that's going through what we'd call a profound structural phase transition.
it absolutely is. I mean, it's shifting from this kind of diversified, lower margin materials company into something else entirely.
Something more like a specialized, high barrier, technology-driven compounder.
That's the mission today. To break that down, are we really looking at a boring, old industrial stock? Or is the market massively mispricing a specialized technology leader with these huge, hidden economic moats?
Okay, let's unpack that transformation. It really seems to begin with a very painful but necessary strategic retreat.
It does. For years, PPG tried to play two entirely different games at the same time, and they were losing one of them badly.
You have to differentiate the two business species that are hiding under that one word, coatings, right?
You do. First, there's the common idea of paint, the stuff you buy at the hardware store,
Yeah.
architectural or decorative coatings.
Right. That's a game of availability. It's all about retail footprint, brand density, just pure scale.
And in the US and Canada, PPG just could not compete. Not against the vertical integration and, frankly, the superior model that Sherwin-Williams built with its own store network.
They were fighting a land war they couldn't win.
So instead of just continuing to hemorrhage capital and, management focus in that low-margin arena, they made a really tough call.
They decided to exit.
They divested their US and Canada architectural business. It's like, in biology, it's called autonomy.
Shedding a limb to save the organism.
Exactly. A strategic retreat designed to concentrate all their mass, all their capital, into the segments where they actually dominate.
So what was the immediate result of that? That ruthless pruning.
The results are, well, they're a clear validation of the strategy.
Mm-hmm.
The remaining businesses, the high-quality specialty segments, they just have a much cleaner financial profile.
We're seeing their margins expand.
Dramatically.
Yeah.
Their adjusted EBITDA margin is expanding. And just to be clear for everyone, EBITDA is earnings before interest, taxes, depreciation, and amortization. It's a core metric for profitability.
And that's projected to hit, what, around 18%?
18.1% in 2024. They've successfully shifted from a diluted mess to a quality-focused specialty player.
Okay, so they've shed the dead weight. Now we can really focus on the technical moats they've been building up. And these aren't just about market share. These are based on chemistry and physics. Let's start with the pinnacle, the most resilient moat they have, aerospace.
Aerospace coatings are, they are the ultimate expression of a switching cost moat. Their products are embedded directly into the nervous system of the global industrial economy.
We're not just talking about something cosmetic here.
No. These are functional seals, top coats, primers for everything from the airframe itself to, say, the cockpit transparencies.
And the core barrier here is what you call the certification lattice. Why does it take so long, up to 2 years, to qualify a new coating for something like an Airbus A350?
Because the risk of failure is just completely unacceptable. A product like PPG's Desithane top coat has to go through these excruciating tests.
What kind of tests?
It has to handle rapid temperature cycling, from the ground to cruising altitude. It has to be completely resilient to these highly corrosive hydraulic fluids like Skydrol. It has to stay flexible as the plane's body expands and contracts.
So once that system is spec'd in, it's part of the aircraft's type certificate. It's locked.
It is locked. And this introduces this beautiful concept of asymmetric risk for PPG.
Where the material cost of the paint is, what, $50,000 on a $150 million jet, it's statistically negligible.
The material cost is totally irrelevant. The cost of failure is catastrophic.
Right.
If a coating fails, you get more aerodynamic drag, the airline wastes millions on fuel. If it leads to corrosion, that plane could be grounded.
And a grounded plane costs an airline upwards of $100,000 a day in lost revenue.
Exactly. So no engineering director is going to risk a $150 million asset to save a few $1,000s on a paint supplier. That quality hypersensitivity is what gives PPG massive pricing power.
It's a fantastic example of selling reliability, not just a material. And they even reinforce that with skill-based lock-in, right, through their Aerospace Academy.
Oh, it's brilliant. It's a brilliant Moat extension. They train the technicians at the customer's own maintenance and repair facilities.
The
MROs. By training those critical people exclusively on PPG products, the specific application, the curing, the viscosity, they create human capital friction. Why would an airline retrain an entire global workforce on a competitor system?
You wouldn't. Okay, let's shift gears. Automotive refinish, body shops. Here, the moat isn't about physics at 35,000 feet. It's digital. It's a data network effect.
It's all about their proprietary digital color library. Think about all the color variances. A silver car in humid Seattle fades differently than that same model baked in the Arizona desert for 10 years.
And PPG's database has millions of formulations that account for those tiny variances to get a perfect match.
Precisely. So if a body shop switches to a generic supplier, they lose access to that brain. Their color matches get worse, you get redos, unhappy customers, arguments with insurance companies.
And they cement this with a physical Trojan horse, the MoonWalk system.
Yes. This is an automated paint mixing machine. The value proposition is simple. It cuts down on waste and human error. It sells the body shop productivity.
But once that specialized hardware is installed,
they're locked in. Physically and operationally locked into PPG's proprietary packaging and their consumables. They're not just buying liquid paint anymore. They're buying an entire workflow system.
Moving to some of the bigger macro tailwinds, PPG seems perfectly positioned for shifts like ESG and the EV transition. Let's start with marine coatings.
This is a classic example of a regulatory discontinuity just strengthening a moat. Look at their biocide-free silicone hull coating, SIGMAGLIDE 2390.
Okay.
Because of stricter IMO, International Maritime Organization rules, shipping companies have to reduce their environmental impact. This coating makes the ship's hull so smooth, it literally cuts hydrodynamic drag.
Which means it cuts fuel consumption?
By up to 20%. And critically, it lowers greenhouse gas emissions by 35%.
So PPG is basically selling fuel savings and regulatory compliance. It becomes a necessary expense, which makes it incredibly sticky.
Exactly. Now, the EV transition, I know there was some initial fear that electric vehicles, being simpler, would have less surface area for paint.
Right, that was the bear case.
But PPG has become anti-fragile here by pivoting aggressively to battery pack coatings.
And what does that mean exactly? What are they coating inside a battery pack?
These are mission-critical applications. First, you have dielectric coatings to prevent electrical arcing shorts inside a high-voltage pack.
Okay.
Second, thermal gap fillers for heat dissipation. And third, increasingly, intumescent fire protection. That's a coating that swells up and it gets hot to delay thermal runaway.
So the dollar content per vehicle for these specialty coatings can actually go up.
It can, yes. And we have hard validation, so this is working. They're partnering with major players like Xiaomi EV. They were just named a Supplier of the Year by Stellantis.
And they're embedding themselves in the process, too.
They are. Their EnviroPrime EPIC 300 electrocoat lets automakers cure the paint at much lower temperatures. This saves the customer a ton of money on energy costs.
So PPG becomes a partner in the automaker's own decarbonization efforts. They're lowering their customer's utility bill, not just selling a product.
That's the key.
And one final resilience mode I want to touch on, packaging coatings. The liners inside food and beverage cans. Seems low-tech, but it's really high stakes.
It's the ultimate regulatory moat. When the whole world shifted away from BPA, bisphenol A, due to health concerns, it created this massive need for certified alternatives.
And PPG was ready with solutions like Innovasense.
Right. And because qualifying a new can liner requires such rigorous food safety testing, once a huge company like a Nestle or a Coca-Cola locks in a certified non-BPA spray, they absolutely will not switch.
The cost of a product recall or a public health scare is an existential risk.
It outweighs any possible cost savings from a competitor by an order of magnitude.
Okay, shifting to financials and stewardship. The CEO, Tim Nabish, his strategy has been very clear. Prioritize return on invested capital ROIC over just, empire building.
That divestiture of the architectural business was the clearest sign of that. They were willing to sacrifice top-line revenue just to structurally improve the margin profile and clean up the balance sheet.
The dividend history speaks to that resilience, too.
Absolutely. PPG is a dividend king. 53 straight years of dividend increases. That proves the durability of the cash flow.
And their confidence in the future of this leaner, more specialized business? It's tangible. You can see it in how they're deploying capital.
You really can. Their capital spending Capex went up by a whopping 40% in 2024 to over $700 million.
And that's not just maintenance.
No, that is aggressive, targeted reinvestment into their highest return areas. Expanding aerospace capacity, accelerating their EV and battery pack solutions, they're putting their money directly into reinforcing the moats we just discussed.
Which brings us to the central question. The valuation disconnect. PPG trades at a price-to-earnings multiple of around, 16.5?
Yeah, about that.
That is the valuation of the old cyclical chemical conglomerate. Meanwhile, you look at a peer like Sherwin-Williams, they're trading at 25 to 30 times earnings. Why is there still such a gap?
Market inertia. It's that simple. The market still perceives and prices PPG based on its history, based on its exposure to that low-margin architectural business they just got rid of.
So, analyst models are just slow to catch up.
And they tend to be. The underlying discounted cash flow models for the stock right now, they only imply about 2 to 3% long-term terminal growth.
So the market is completely ignoring the optionality from the high-margin aerospace supercycle and that high-content EV pivot.
Precisely. The opportunity here is the re-rating thesis. As the market wakes up to the fact that PPG is now a structurally cleaner, higher quality company, as those EBITDA margins stabilize above 18%, the multiple should expand.
And if that happens?
Look, if the company achieves, say, $8.50 in earnings per share in the next few years, and the market re-rates the multiple to just 20 times, which is still a discount to peers.
Yeah.
That gives you significant upside just from the PE expansion alone.
Before we wrap, we have to talk about the primary risk, the thing that could derail this thesis, and that seems to be geopolitical fracture risk.
This is critical, and it ties directly back to their successful EV pivot. PPG has significant operations and exposure in China, especially in the auto sector.
So if geopolitical tensions rise, if we see an aggressive trade war,
For instance, heavy U.S. and European tariffs on Chinese EV makers like BYD or Xiaomi, that directly hurts PPG's key, fast-growing EV customers in that region.
so a trade war could slash the demand for the very high-margin coatings we were just praising. That's a real, tangible threat to the growth story.
It is. The other major risk is still the lag effect when raw material prices spike. They buy a ton of titanium dioxide and specialty resins.
And even with their pricing power.
There's usually a 3 to 6 month lag where costs rise faster than they can pass them on, and that can squeeze margins temporarily.
So to synthesize all this, what's the final verdict on PPG?
The deep dive confirms that PPG Industries is an asset we would categorize as quality at a reasonable price. It's not a capital-light software monopoly, but its competitive durability is enormous. Its moats are not based on some fleeting brand loyalty. They're based on the physics of attachment, the impossibility of switching because of regulatory risk, and the fact that rust, quite literally, never sleeps. Demand for asset protection is just enduring.
So we're looking at a wonderful company that's still in its chrysalis, and we're buying the butterfly at the price of the caterpillar.
That's a perfect way to put it. And this whole analysis, it raises an important challenge for you, the learner. Since these traditional industrial sectors are so often overlooked because of low PE ratios, what other companies are hiding in plain sight?
Companies making specialized components or chemistry?
Exactly. Which ones might be leveraging these same complex regulatory lattices and tech boats that the broader market is just ignoring right now? That pursuit of hidden quality. That's where the best returns are often found.
A truly insightful deep dive. Thanks for guiding us through the complexities of PPG's transformation.
My pleasure. It was fun.